Fair value gaps are not magic, they are engineered. And once you understand why price returns to them, everything changes. Most traders draw every single fair value gap that they see and they trade them blindly. And that's exactly what's getting them stopped out. In this video, I'll be simplifying fair value gaps so that regardless of your skill level, you can use them to print money. I'm going to break it down into three main sectors. Number one, the purpose of fair value gaps. Number two, how to identify fair value gaps step by step. Number three, the theory behind the fair value gaps so that you understand why it works and how to use them dynamically. If you're tired of guessing and want to create fair value gaps with precision instead of hope, then let's not waste any more time and let's get right into the video. Now, before we go into fair value gaps, you first need to understand how the market moves. Okay, so what drives market movements? Alright, some of you all may hear this term, right? Internal liquidity to external liquidity. IRL to ERL. Price moves from point A to point B. Now, what fuels that move? Alright, it's going to be two things. Write this down, liquidity zones and fair value gaps. Or sometimes even OP. Okay? Now, first things first, for liquidity zones, these are things that you see. Your equal highs, your session highs and lows, Asian high, Asian low, for example. Your daily high and low, your 4 hour, 1 hour highs and lows. All the higher time frame points of interest are going to be an area where stop losses are going to be sitting, right? Especially those people that are timing the bottom, they are looking to get in there because the stop loss just right underneath it. Or perhaps maybe they got limit orders or sell stop orders right there, or buy stop orders right there. These are always going to be key areas of liquidity. All right, and this is what we call external liquidity. Right, whenever you see price take out a higher high in an uptrend, what do you normally tend to see right after? A pullback. If the market here is in a downtrend, it creates a break past the lower low. Eventually, you will start to see the market here give us a pullback. Why? Because external liquidity has been hit. It is now looking to search for internal liquidity. All right, so what else makes the market move? Fair value gaps. All right, now I'll explain more in depth later what fair value gaps is and of course how to spot them. But those of you guys here that already know because you watch the live stream, all right, fair value gaps are basically an area to look to buy or sell from, all right, and is created by an imbalance of buy and sell orders. So if you have a bearish fair value gap, you have an imbalance between the sellers, which is way higher than the buyers, leaving orders behind, waiting for them to come back and fill it. All right. Now, fair value gaps here are always in a cyclical pattern in which it forms and then it gets filled, respected, dump, and then fill. It is always that cycle. Eventually, fair value gaps here will be filled. You need to understand this. Whenever a fair value gap is formed, price will eventually fill it, no matter how long it takes. Sometimes you have a daily fair value gap here that's formed, and eventually, after maybe 1 week, 2 weeks, it comes back to fill it. So always understand this. Fair value gaps here will eventually get filled and used. That's the whole point. They drive the market from point A to point B. Gives the market momentum. Okay? So these two things are basically the lifeline, the lifeblood of price action. It is what makes the market move. Alright? Now, fair value gaps are going to be considered internal liquidity. Why? Because it always happens in between price action. You will see an example later on. Alright? If you see a swing low and swing high, what happens? A fair value gap doesn't form at the swing low or the swing high, but it forms in between. Hence the term internal liquidity. So, to bring both of these concepts together, liquidity zones and fair value gap, you have your external liquidity and internal liquidity. So you see the market here go up and come down, go up and come down. What price is just doing is moving from a point of external liquidity to internal liquidity to collect orders to push price back towards external liquidity, back and forth. That's how price move up and down in the markets. Is everybody clear on this? Crystal clear, yeah? Okay? This is what fuels the market movements every single day across all financial assets. Okay? Very good. So now, how do you identify a fair value gap? Let's go through it step by step. Okay? Let's move on to how to identify fair value gaps. Very, very simple. Okay, write this down. It is a 3 candlestick pattern. Candle 1, candle 2, candle 3. It has to be consecutive. It has to be closed. Okay, so in a bullish fair value gap, what you want to see is price moving higher. Any 3 candles here, as long as it moves higher and there's a gap between the first candle's top wick and the third candle's bottom wick, and it does not overlap like this, you see this wick here and this wick here, there is a gap created, right? This is where there is going to be a fair value gap. Now, why is there a fair value gap right here? Once again, there's an imbalance between the buyers and the sellers. There's way more buyers than sellers. And of course, what will happen is that orders will be left behind. Later on, I will have an illustration to really zoom into this later on. Okay? Now, if you're asking, does the candles have to be the same candle? Or, correction. Does the candles have to be the same color? No. It can be bullish or bearish. For example, if let's say the market here decides to do this, alright, create a bearish candle instead, make this red. This is also a valid fair value gap because the wick is not touching this. So the points of fair value gap, the focus of how you identify fair value gaps is not the color of the candle, but where the wicks are. As long as there's a gap between the wicks, between a 3 consecutive candle pattern like this, there is a fair value gap. Same thing for the bears, Fair value gap is identified by what? The first candle's bottom wick creating a gap with the third candle's top wick, not overlapping each other. The moment you see price action here create something like this, do you have a fair value gap? Yes or no? No, you do not, because there is no gap between the first candle's bottom wick and the third candle's top wick. Alright, so this is invalid. This is valid. You must see gap. Is everybody clear on how to identify a fair value gap? Step by step. First step, identify 3 consecutive candles. Step 2, look for a gap between the first candle's wicks and the third candle's wicks. Okay? The candle can be black, white, yellow, green. I don't give 2 shits. The focus is on the wicks. If the market here is moving up and you create a gap upwards, then cool. You know that this is a bullish fair value gap. If the market is moving downwards, right, and it creates a gap like this, then this is a bearish fair value gap. What if there's no wick? Good question. If the market here doesn't create a wick like this, then how? Any guesses? Very simple. Use the body. It is still a gap. It's still a fair value gap. Okay? Clear? This is the most important, especially for beginners. Clear? Very, very good. So now, let's move on. What is the theory behind fair value gaps? Okay? So this is the theory right here. Okay, I want you to really focus on this. What happens inside this fair value gap, and why is this going to be considered a fair value gap? Why are there pending orders right here? Okay, so this is going to be a zoom-in version of what price action here is doing on the lower time frame. When price is pushing up higher, it's creating higher highs and higher lows, higher highs and higher lows. And each and every single time, the market here is moving up very rapidly, leaving orders behind. How do you know it's leaving orders behind? Because those that miss the move from here to push up higher, what are they going to do? They're not going to buy the top. They're going to leave buy limit orders at the bottom, below where the initial move happened. Because they're expecting price to go up so that they can get in at a better price to push price higher. Alright? So that's why you see right here, you take a look, I'm going to just go ahead and follow it. Candle open here. Okay? Push up, come down. Push up, come down. Push up. Can you see the same exact pattern here? So these are where people are placing their limit orders, their pending orders. So as long price respects the fair value gap, price can collect all these orders here eventually to push price higher. Alright? So whenever you see price action here create a gap like this entire area here where there are all the pending orders is an area with a lot of liquidity. Once again, where price action here can come back to fuel the market to push price higher. That's why fair value gaps here are points of interest of where you can look to buy or sell from. Make sense? And same thing, it forms because there's an imbalance between the buyers, which is in this case here very high, and sellers, which is basically much lower. There's a difference between them. A lot of people are looking to buy and sell. Okay? Now, remember this. Okay? Whenever you talk about fair value gaps, you only focus on the 3-minute candles. Any other candles outside of that, you don't care. 3-minute candles. Not a 4 candlestick pattern, it's not a 5 candlestick pattern. No. 3. 3 consecutive candles. That's it. Okay? Is everybody clear up to this point? These are going to be your pockets of liquidity where price can come back into, aka our internal liquidity, as we have mentioned earlier on, right over here. Alright? Fair value gaps are internal liquidity. Very good. So now that you understand what actually goes on within a fair value gap and why it's an area for price to continue going higher, for example, in this bullish fair value gap, and why price can eventually come back into it, let's move on. I want you to understand this. Fair value gaps are, once again, this is a live chart example of fair value gaps. In fact, I took this from the hour chart, alright, last night. Okay? When the market here moves down in one direction, like this, it forms because there is an absence of buying or selling pressure. In this case here, is it buying or selling pressure, Chad? There's an absence of buying pressure, right? Because the market here is moving down very aggressively. So the market is trending down. Means what? A lot of sellers, lack of buying pressure. Is that clear? And in this same scenario, guess what? Price is going to create moves like this. And all these areas here are where they're going to be liquidity sitting. Hence your fair value gaps. Okay? Just like the drawing I've shown you all earlier on. Okay? And the gap identification, your gap is only between the impulse candle and the adjacent candles. Which is why it is a 3 candlestick pattern, not a 2 candlestick pattern or a 5 candlestick pattern. Just the adjacent candles, the one side by side. Okay? And these are going to be your pockets of liquidity in which the market here can use to tap and give us a continuation move lower. Now, why do we expect price to come back into it? Once again, price moves from internal area of liquidity to external area of liquidity and vice versa. It's a cycle. Alright? And since this fair value gap is considered a point of liquidity, price can come back up into this area here to tap and give us a further push lower. Alright? And of course, those of you guys here, they are asking, then Nick, what time frame do I use the fair value gaps on? Any time frame. I repeat, any time frame. Remember, this is a concept, not a strategy. Strategy, yes, it will be time frame specific. But if you're using a concept, this concept can be applied on any time frame. It can be the 15-second, the 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, monthly, any time frame. Okay? Now for the last part of this Zoom session right here, I wanted to show you how you can use the fair value gap right here. Now you have a full understanding of exactly how fair value gap is formed and how you can use it. Alright? By expecting price to come back into it to reject it. Now, how do you use the fair value gap to give you direction? Where is the market going to go using the fair value gaps? Now, this will be the last part of this Zoom session. Let's take, for example, right here. What do you see? Bullish price action. Higher highs, higher lows, higher highs. And like I mentioned, your swing points are what? External highs and external lows. I repeat, external highs and external lows. These are your swing points of liquidity. So whenever price takes out a swing point of liquidity, good. External high taken out. So what is price going to naturally do? Move towards an internal level of liquidity, which is what? Fair value gaps. So this is where you decide, okay, is price going to push up or is price going to go down? So how do you know? Alright, someone here asked a question, Nick, I noticed how you can tell when the fair value gap is going to fail and when it's going to turn into an IFVG. How do you do it? Good question. That's exactly what I'm about to see right here. Okay, so how you tell is by how price reacts coming into the fair value gap. Okay, I repeat, is by reacting to how price unfolds in the fair value gap, the reaction of the fair value gap itself. If price shows us a clear reaction, for example, a tap into it and a strong change of character towards the upside on the lower time frame, then is it clearly a respect to the fair value gap? Yes or no? Yes, sir. Right? And normally what this would happen on, for example, let's say this is a 1 minute reaction, this is a 15-minute price action retest. What will form is a wick, respecting the fair value gap. Which is why I say if you see a wick in the fair value gap, this is respect. If price closes underneath and breaks through the fair value gap, means what? Okay, hold on, let me just do this. Let me just remove this. From here to here, if let's say the market here pushes underneath and closes with a body candle close, you fail the fair value gap, which turns into the IFVG, right? Of course, but that's another topic for another time. Price has collected all the orders here and price still cannot push up higher. It's a weak reaction. Does not have enough orders, enough liquidity to fuel the move towards the next external area of liquidity. And if price fails the internal area of liquidity and price naturally wants to go into the next external area of liquidity, if this is further away, where's the nearer price point? Here. So that's why whenever you fail the most recent fair value gap, you can use it as a bounce price to target the external liquidity. Is that clear? Clear? Very good. So remember, the moral of the story here is whenever you see price come into the fair value gap, what is the plan? Right here. Look for the reaction. How is price reacting off the fair value gap? Which is why I always emphasize, I don't just set a buy limit at the fair value gap itself. Why? Because I want to see how price react. Is it going to be a strong reaction? Or is it going to be a body candle close underneath? So that's how you tell whether the market here is likely to come back down for a potential change of character, or is price going to continue going bullish, all based on the most recent fair value. Is that clear? Alright, so today we covered a lot of things. Let me summarize. First of all, we covered why do we need to use fair value gaps and what is their function in market movements. It functions as an area or as an internal liquidity point for market to come and test and push. Okay, this will tie into liquidity zones, your internal and external points. Now, how do you spot them? Very simple. 3 candlestick pattern. Then we went through what actually goes on the lower time frame when you spot the gap. So you understand that this is a key area of liquidity that price can eventually come back to collect orders to push price higher. Okay? And from there, give your key pointers to take note. When fair value gaps are formed, it is strictly using a 3 candlestick pattern, and price is eventually going to use this area here to tap and push in that direction. That's what we are expecting from the fair value gap. To push it towards an external point of liquidity. Alright? And it forms solely because there's an imbalance between buyers and sellers. If it's a bearish fair value gap, there's an imbalance between the sellers being too strong and there's not enough buyers in the market. Then, the last thing that we went through is how to use fair value gaps to tell you where price is going to go. Okay? Okay, in the next educational Zoom, which is going to be next Wednesday, I'll be going through a little bit more in depth on how you can use fair value gaps with key live examples on the chart. And the more advanced, nuanced things about fair value gaps here that you can use to take advantage of the market. Alright? So this is part 1, part 2 is where it gets juicier. But I need to make sure that the foundation is laid out nicely for you guys here so that you guys here can take advantage of fair value gaps here on stream.